when you look at the global markets or the local markets as well, you can look at them as a glass half full or a glass half empty. A lot of people have made wealth by being in the right quadrant at the right time. Some people have lost wealth because they have been in the wrong quadrant or the wrong stock in the right quadrant as well. The question always boils down to which stage of the cycle that we are in, whether it's the business cycle, whether it's the economic cycle or the market cycle. And let's try and talk about somebody who looks at business cycles and then try and map technicals to those individual quadrants. Martin J. Pring, the founder of Pring Research, joins us in our studio to talk about all that and more. Martin, it's a pleasure having you on Bloomberg.
Thank you. It's delightful to be here.
Great. So can you tell us, Martin, about how do you contextualize different asset classes and which quadrants or which spaces of the cycles that they might be in, and what does that imply for markets?
Well, we start off with the business cycle, because a business cycle is nothing more or less than a chronological series of events. And the three financial markets, bonds, stocks, and commodities, all fit into that chronological sequence. And if you can figure out where we are in the cycle, then you can allocate your assets much more efficiently, either in inflation-sensitive stocks or deflation-sensitive stocks.
Okay.
So here's the diagram, and it's basically showing you a theoretical business cycle with a contraction on the left and a recovery on the right. First thing to happen is that bonds bottom out as the Federal Reserve or the central bank, whatever it is, starts to ease up on pump liquidity into the system.
So sorry, I just want to, for the clarity of our viewers, just mention this. The B, S, and C is bonds, stocks, and commodities?
Yes, thank you. Thank you. I should have mentioned that.
No, that's okay. So now if you can please explain to us, because even I'm interested in knowing what is it trying to imply.
First thing that bottoms during a bear market or during a recovery, the contraction, is bond prices, bond yields peak. And then of course money goes into the system, and people in the equity market begin to anticipate the next recovery. So that's why you see S at the bottom when the news is blackest, when it's really, really bad. And then as time goes on, the players in the stock market are rewarded because we do get a recovery, and that gives you a chance to have commodities to rally. So at that point, everything is going up. And the next thing to happen, of course, is that the economy does take off a little bit, and demand for credit picks up, and therefore the price of credit, interest rates, also starts to bottom out and go up. But because profits are going up at a faster pace than the interest rates at that point, stocks can continue to rally. And they finally peak when the news is at its best, at the top of the cycle. And then as we roll over, so eventually commodity prices start to peak as well. So we've got this sequence of events that takes place throughout the cycle.
So according to you, what part of the cycle are we in currently?
Well, you see that green shaded area on the diagram there. That tells you where we are in the current cycle. Perhaps you could put that up again. So what we've seen a rally in stocks since last December. And the next thing to look for is a bottom in commodity prices. We don't see that bottom yet, but it could be very close, because commodities, industrial commodities, are very oversold at this point.
And stocks, according to you, are they also making that bottom?
They made a bottom last December, and are likely to move higher based on my longer-term indicators.
It's interesting you say that, because the S&P 500, Nasdaq, Dow Jones is still at record highs. So when you're saying they've bottomed out, how are you correlating, the stocks versus the index? In what context?
Well, I'm saying that the index is going higher, and the broad list is going to go higher. I can't say every sector is going to go higher.
Okay, so this bottoming out happened in December. We've already moved up higher. By virtue of what you're trying to say, and correct me if I'm wrong, that commodities will bottom out at some point of time, but in this phase, stocks will continue to move higher. So do you anticipate a continued uptrend for the US markets and maybe the large other world markets as well?
Oh yes, absolutely. I think the global market, as measured by the MSCI World Stock Index, is going much higher, because all of our long-term momentum indicators have only just started to turn up and give us a buy signal.
Where do you find this? I mean, where do you find the maximum bullishness case, Martin? US is, anyways, as Devina said, is already doing that. We don't see too many European indices up there, and Asia has a mixed bag of sorts. So which of the economies or markets do you find the strongest?
The US.
Okay.
You believe it could still continue to outperform the West?
It's still the US, yes.
All right.
Okay. That's the mother market. If that performs, it's great for the world markets. Do you reckon that some of the other emerging market economies could also do well?
Well, you mentioned Europe earlier, and if you look at the some of the indexes on Europe, they're at just below a 20-year resistance level, and their long-term momentum has started to turn up. So there's a pretty good chance they're going to go through that resistance, and if they do, that's a 20-year resistance. That means you're going to go much higher, just like stocks did in the U.S. for the Dow in 1982. They had this pretty huge base, and then they broke out to the upside. Emerging markets, yes, also look very interesting. But I still think it's the U.S. is probably going to do better.
So when you're looking at these cycles, are you also looking at specific levels on these indices? And from a technical analysis standpoint, are there any levels that one should keep in mind for any of these major markets that you just spoke about, even the U.S. for that matter?
Well, in the U.S., of course, we're at record highs.
So it's uncharted territory. So
we're in uncharted water. Yeah, that's right.
So, so you feel that this could still keep the momentum going?
Oh yes, I think definitely, because usually what happens is, remember, in the cycle, you bottom out in bonds, then stocks, and then commodities, and then stocks could still have a life after commodities have bottomed out. Yeah. And they still have a life after interest rates start to go up.
But you don't look at levels per se. You look at percentage gains maybe, or a continued period of outperformance, but you don't have thoughts about what the S&P from the levels that it is at could go up to.
Not usually, no. As far as I'm concerned, the trend trumps everything. So you want to know whether the trend is up. When the trend changes, then it comes down, obviously, and then you take a bearish stance. But as long as those indicators are pointing north, I'm bullish. If they start to turn over again, then I have to look at the new evidence and say, not so good.
So from bonds, equities, and commodities, with regards to even keeping in mind a portfolio allocation, risk balancing, maximum weightage you would give in the current context to equities?
The maximum what, sorry?
Weightage to investing. If you have a pool of money and you want to invest and diversify, which segment or which asset class right now?
Which segment?
Yeah.
Well, so far in the I can only go on the U.S. here with this analysis. So far in the U.S., it's been defensive stocks, things like consumer staples, home builders, stuff that does very well, interest sensitive, early in the cycle stuff. Utilities will be another one. As the cycle progresses, so you move into the earnings-driven sectors, things like materials and metals and energy and those sort of things, commodity-driven stuff. And we're kind of on the edge of improving in those areas. But so far, in this cycle, we've seen just mainly the defensive stocks do better than the offensive stocks.
Yeah. So when you talk about commodities, obviously a lot of other factors impacting what commodity prices do, not just what phase of the cycle you're in. A lot of global driven news. We've got the trade talks, you've got the China demand slumping, a lot of external factors weighing down.
One of the great things about technical analysis is you just look and see what the chart says, and you don't have to worry about these peripheral things. And if you take a chart of global commodities and you take the OECD normalized leading indicator and you put it underneath, you can see every time this indicator bottoms, commodities on a global basis bottom as well, almost every time in the last 40, 50 years.
So this is historical. I mean,
so commodities are very much driven by demand, which is where the economy is a proxy for demand, of course.
Okay. The one thing that could, I wonder if you have a view on India, Martin, on the headline indices, and if you've looked at any sectors within India. I do not know if you have or no, but if you have, can you tell us about that?
I've taken a very cursory glance at it because I don't have the data to work on. I have in the US with breadth data and all kinds of stuff like that. But what I have noticed is that the automobile index, the CNX Autos, looks kind of interesting right now. It looks like it's bottomed out. And I'm also watching metals and commodities as well because they're tied into the global cycle. And if the global cycle turns up, these will be places to look at.
Okay.
What is interesting, though, is the technology, which I would have thought would have done well at this point, is starting to roll over a little bit as it stands right now. And, of course, things can always change, and if they do, we have to change with the markets. But right now, the commodities look more, the technical area looks a little bit, the IT looks a little bit vulnerable.
You're talking about the Indian IT index looking vulnerable?
India, yeah, the CNX IT, yeah.
Okay, so that looks
I'm not going to go bearish on it, but it doesn't look as attractive as, and the consumer as well. The consumption index looks pretty interesting.
Interesting by that, are you mean that it's topping out, or does it look like it'll show some signs of revival?
When I say it's interesting, I mean it's interesting from a bullish point of view.
Okay.
Yeah.
So probably, going neck and neck with what consumption in US is.
Yeah.
So
Yeah, exactly. And if you look at some of these Indian sectors and you adjust it for the currency, they move very, very closely to what's happening in the US to the equivalent sector.
Can you elaborate a bit on that? You're saying stripping out of the INR or the rupee rate
Well, if you take the
differential.
financial, CNX financial index, for example, and you compare it to the XLF, which is a financial thing, ETF traded in New York, adjust it for the currency, there's a very, very close relationship. Now, the magnitudes differ, but the cycle, the highs and the lows are pretty well very, very similar. They differ a lot. They differ a bit, but there's a definite connection you can see when you adjust it for currency, whereas you're looking at local currency terms.
And since you mentioned currency, I actually wanted to get your view on, how does all of this play out for the dollar? Do you track? Would you be able to give us an idea on how the dollar?
All I can say about the dollar is that it's in a bull market until proven otherwise. And one of the things I look at is its relation to its 12-month moving average. At the end of last month, it was right on the average. So I don't have a really strong opinion because it could snip through the average this month. But I see the dollar at this point as it being in an uptrend. But if we get some negative influence, some negative indicators taking place, then I'll be a little bit more concerned.
Because that's also a function.
Right now, as it stands today, I'm bullish on the dollar on a long-term basis.
Okay. My final question, Martin, and I'll just take the clock back to India. You mentioned about being bullish on consumers, to an extent autos, which form a part of consumers in India loosely. The one large sector in India is financials, banking. I don't know if you've had a chance to look at the Bank Nifty or any of the large financial names. Are you bullish? Are you bearish there?
I can't recall what the financial charts are. I was only bringing the ones that stood out to me.
Any view on India then, as an index? Have you looked at the Sensex and the Nifty by any chance and had a look at what those charts indicate?
Yes. They're in an uptrend. We're talking in local currency terms here.
Yes.
It's in an uptrend and the long-term momentum is coming down, so you've got a conflict. Now, if it goes higher, as I'm expecting the world index to go higher, then I would imagine that the Nifty and the Sensex would follow the rest of the world up.
And the momentum would start to come back in.
And also, since it's in a bullish trend, you always assume it's going to continue until you get evidence that shows it's reversed.
Because the Sensex is also at record highs.
Yes.
Yeah, in India.
But the long-term momentum is rolling over. Now, the S&P was doing that for the last 6 months, and it hasn't held the S&P back. It's just that it's not the perfect picture where the momentum is turning up and the price is above its average.
Okay.
That's the problem.
Okay.
But it's not a serious one necessarily.
Well, that's a good sign. There is a problem, but it's not a serious one. But Martin Pring, so good having you in our studios today. Thank you for taking the time out.
Thank you. I've enjoyed it.
Yep, we have enjoyed it too, and I'm sure our viewers have learned a lot from this opinion as well. Viewers, thanks for tuning in to this leg of Indian Open. It's a wrap from Devina and me and the team that put this show together. Thank you so much for watching, but stay tuned. The FNO show takes forward the action on the other side.